Good morning, everybody. This is John Blank, Zacks Chief Equity Strategist and Economist. Going through a new sector today. This will be the start of a multi-week series on basic materials. And you might want to ask yourself, why are we looking at basic materials? Steel, chemicals, paper, gold, non-metals, non-ferrous, steel, iron mining, things like this. Answer is because we're going to shape our global edge. These are the manufacturing materials of choice for everyone in the world, particularly China, mainland China. And we're going to be able to shape a global edge and a meaningful understanding of how the world economy is going to play out by understanding the component parts of basic materials. That is the bigger picture idea. And why I like to do this. Too many times people spend a lot of time at top-down work and they don't get into the details. And if you don't get into the details, you get narratives and themes that are way too broad and not helpful as an investor. We are trying to find investments, better choices, and better themes that work. Then we can pick stocks. Obviously, the next two sections, maybe one, we'll find out, will be ETFs and stocks. So generally speaking, people I want to look at the page views, you simply don't like these broad things, but there is a very critical job to be done here. First is just to lay the foundation for us understanding what basic materials are as industries, how they interact, how their metrics look. So part one will be balance sheet metrics. First, of course, will be return on tangible equity because we are looking at it as investors. R&D is percent of sales. Of course, if people are investing in their business through R&D, they have opportunities there. And we'll get through total debt to capital expenditures, and a few others. Of course, then we'll turn to profit metrics like we always have, revenue forward 12-month earnings, free cash flow, and free cash flow adjusted yield, and free cash flow to net income. Finally, of course, since we're going to invest in this sector through stocks, we'll look into a variety of metrics that measure on a forward 12-month look their share valuations, enterprise valuation, price to earnings ratios, the PEG ratio, and of course, we'll finish up with probably what is the best metric for this sector, which is price to sales, because there's a lot of differences in the profit margins and various other ways that people invest in this broad variety of industries. So like I said, the problem lots of times with people looking at industries like this, that they have this interest in bull bearing the whole industry, and we're going to find out that there are parts of this industry that are looking sort of sharp, and we need to focus on it in the later stages and not the rest. So, of course, let's go through our disclosures. Yes, these are the views of me, John Blank, PhD, and they're not necessarily the views of Zacks Investment Research. So, on we go. Balance sheet metrics, like I said, return on tangible equity, R&D as a percent of sales, total debt to total capital, CapEx, and cash flow to accruals. Let's get going. Return on tangible equity. These are relative ratios, people, for basic material subgroups. So they're relative to basic materials as an industry. So this is how it looks relative to the industry. That's what these are going to be measuring. So you can see, obviously, one will be where we often see an industry that find its way. So, for example, let's take a look at chemicals first. Plastics and diversified chemicals are two different industries. Plastics, of course, more commodity-like, diversified. You're adding value by positioning chemicals downstream in various segments. So, of course, there was a big run-up in the ROEs of the chemical makers, diversified chemical makers, into the pandemic. And then they've come all the way back down. Over here, you get the silver, gold mining, and miscellaneous minings versus the non-ferrous, which is the non-precious metal ones. Notice the mining non-ferrous is very cyclical. And we're actually just coming off a high here. In fact, we're coming off a lot of highs. So this is telling you that the cooling in the global economy is ongoing. And it's also not dramatic. These are all not at anything near lows. They're all just cooling off. So over here, we've got iron mining, steel producers, and specialty steel producers. Specialty steel producers are kind of like your diversified chemical makers. They're going to be in niche businesses downstream from the broad commodity steel producers. They have a different story. This, of course, is the paper products group. They are tied to consumer products. And of course, they're going to show us a longer stretch of damage here because of the supply chain shortages that affected their business. So notice here, you've got the diversified chemical makers spiking. Here you've got the non-ferrous going through something of a dip well before actually COVID. There was some downturns. And here you've got a classic period showing you just really how long the supply chain shortage played out, almost for 2 years. First, there were shutdowns. Of course, there's that recession line. But now look, there was much bigger problems for them in the 2021 period when things got cranking up. That was the supply chain shortage issue. So again, how many themes do we have here? Lots. Diversified chemicals versus plastics. Paper on alone is very different. Metals non-ferrous versus those that silver and gold. And of course, over here, again, if it's going to be specialty steels versus steel, very different stories. All right, R&D is a percent of sales. I just want to point out, broadly speaking, whether it's over here or over here, these two industries are showing you something important. R&D never recovered as a percent of sales after COVID. I don't know why that's the case, but it's not a real good statement for us to think that these are strong industries if they're not investing in their R&D at percent of sales. The only thing I will say is there is some evidence here that they have recovered and are moving up. So the better thing to say is they are much lower, but they are improving. Total debt to total capital. You don't want to have a lot of debt. I just want to point out a lot of these groups were piling up the debt outside of paper, which of course had its own issues because of the shutdown. Over here, you can see the chemical producers and the steel producers really unloading their debt into well before the recession. So there was already tightening of their business models well before the recession. And you're going to see here specialty steels holding up a little better in terms of separating themselves from steel. These are fascinating stories to keep in mind. So the debt levels really picked up in 2016, 7 years ago. Very different story now. They're not too leveraged. That's actually bullish. Capital expenditure, fascinating one to point out here is paper. Paper CapEx is exploding. Very interesting situation here for paper. You're going to find this industry is probably bullish and is really changing. It's got effects on consumer packaged goods consumption. And what this is telling you is the consumer is spending on goods. And the paper groups are now putting CapEx into their plants to re-gear them. So they had a long period for 2 years they didn't, and now they're catching up. My guess is that's the bulk of what's going on at paper here, is they're catching up with issues they could not catch up through the supply chain shortage. Once again, paper shows you supply chain shortage issues. These others basically don't. Reinvestment rate. So reinvestment rate is over here. I'm telling you what it is. The reinvestment rate measures the percent of a company's after-tax operating income that is allocated to CapEx and net working capital. So you'd like to see people put money back in their businesses. And look at this, paper. People are really investing in paper. And over here, you can see the specialty steel makers are ramping up while the steel producers are coming off highs. Generally speaking, steel is doing pretty well. Over here, the metals non-ferrous are the most cyclical once again in their reinvestment. And of course, over here, you've got something that's kind of moving towards the mean. Asset turnover, I just want to point out what this is. Asset turnover is a ratio that measures the values of company's sales relative to its assets. So the higher the asset turnover, the higher the sales to assets, that's more efficient. The lower it is, that doesn't mean you're not as efficient. So you'd like to see this higher. So where do we see it higher? Basically, again, mining non-ferrous is much higher than gold and silver. Over here, you can see paper is very inefficient. We know this. Again, I would probably not compare paper's relative ratios to any of these others because it's really a different business with it gearing very differently downstream. Again, that's what we're looking for here is to understand that these broad stories can be very different. For metals, non-ferrous versus gold and silver, very different. Paper, very different. Specialty steels, different than steels. Cash flow accruals, we're going to skip through this. Too jumpy, too noisy. Just point out that you want to know that increases in accruals have a positive impact on free cash flows when people are paying us better. When you decrease your accrued expenses, it goes down. So that means you're paying people out. So you can see there's always seasonality in this. Times interest earned, you'd like to have a bigger number, not a smaller number. And again, look at paper, getting much stronger. That shows you the spending out there and the consumer is strong. And there's a basic material element to it coming through the paper channel. Over here, you can see specialty steels again doing somewhat marginally better in terms of their trend. And that, as an investor, you'd want to point out specialty steel maker, probably the place to look for a trade. Okay, so depreciation, amortization, and tax rates, I'm going to skip, but you can look for these slides from us and get into those stories on your own. They're not as material to an investor. So now let's get into the profit metrics. Of course, this is all these things. On the left side, I've got revenue and earnings, free cash flow. The others are just subtopics: earnings retention, earnings recurrence, and the net repurchase yield. So we've got basically big topics and subtopics of those topics. Let's get through them. My revenue, forward 12-month look. Diversified revenue is actually relatively better than plastics. Of course, that's a commodity business. Specialty steels is actually much worse than steel producers, and mining is actually fairly strong. Iron mining has been a good business. Mining non-ferrous, again, at the top, we're going to always see mining non-ferrous kind of pull ahead of the gold and silver producers. Particularly silver is very lower, much lower than gold. Its prices are much lower, of course. And down here, revenue forward 12-month, all I want to point out is it's creeping up for the paper groups. Again, a positive look for that industry. Earnings, of course. Let's talk about the plastics industry. Big run up during the opening. Now it's coming off its highs. That's probably the cooling that the Fed does want to see. And you're seeing the same thing tied together for the steel producers who are coming off their highs. And once again, here's your bull trade. Specialty steel earnings are coming up. Specialty steels, keep it on your radar. And of course, over here, we're looking for trades. And again, mining non-ferrous comes up in second of the four. And the worst is silver. That's always going to be the case. Silver doesn't seem to get much of a bid. Gold does. I don't know the whole story of silver and gold, but there is some element to downstream battery basic materials that these slides will not get into, but they're not clear to me which one, silver or gold, benefits most from that. Free cash flow. Of course, more free cash flow is better. Where do we see it? Diversified chemicals actually doing quite well. Keep that in mind. Mining non-ferrous, again, very cyclical, but also higher. And down here, iron mining, again, off its highs, but still decently strong. And now we're seeing something because of the CapEx spending that paper is doing, their free cash flow is down. So this is related to that CapEx that they're now catching up on. Free cash flow adjusted yields. Of course, here we'd like to see this yield be higher. Where do we see that? Generally speaking, I don't see a lot of trades here. Again, silver is weak versus mining miscellaneous, which is strong, and everything else is basically close together. Free cash flow to net income, too noisy a slide to bother with. Let's skip it. Earnings retention. Interesting topic. If you're retaining earnings, you might have purposes for them. Where do we see something interesting here? Generally speaking, I think up here is the plastics versus the specialty chemicals. The plastics are retaining more earnings than the chemical specialty makers. Fascinating idea. Again, it's probably has to do with differences in their business types. Earnings pureness. This is just how much we can fundamentally believe in the earnings. And again, we're seeing something interesting here. Iron mining coming cleanly out and breaking free. And again, metals non-ferrous, mining non-ferrous, doing much better than the gold and silver miners. Again, that's a story we've heard over and again. Pureness, the plastics makers are doing better than the diversified makers in this category. Net repurchase yield. This is really a jumpy thing. You can see over here, a lot of repurchasing for the paper groups before the pandemic, not so much now. Same is true for the chemical makers, did a lot of repurchasing before the pandemic, not so much now. And this is basically the case over here for the miners as well. Not doing as much, but this is just because they're using the cash for other purposes now than share buying. They're actually opening their businesses and running them. I think that probably makes the most sense of that type of information. So now we're down to stock valuation metrics. Let's get through this. Enterprise value up front, price to earnings at the back, and price to sales is what we'll finish up with. Okay, enterprise value. We'd like to see this rising. Where do we see it? Steel producers. Clean play here. Clean play. Actually, the paper groups, while are way down off their highs, are trending higher. We like to see that. And else we like to see, again, the mining non-ferrous in versus the others. Unclear story here. So basically, again, we're seeing steel producers and the paper groups somewhat stronger. Enterprise to sales. Look at this. This is what you like to see. Again, that's telling you the consumer is strong and packaging is big for paper. Keep that in mind here. The consumer is playing out, and it has been doing so since late 2021, the openings happened. Very different basic material industries than the others. Over here, specialty chemicals are doing best from an enterprise value. People like them better. They pay more profit margins. They probably better place. I like this chart for chemicals, especially the top, diversified in the middle, plastics at the bottom. Keep this chart for that industry well in mind. Over here, you've got iron mining, which is actually coming down, but trending up. And again, we've got a nice trade here for iron mining, and the steel producers also trending up off lows. Keep that in mind. Price to earnings ratios. Of course, this is your classic thing. Remember, this is relative ratios, so this is somewhat unhelpful because of the relative nature to the basics of these different groups. Only thing I'm going to point out here is, again, specialty pays more than diversified, pays more than plastics. This is your value chain in chemicals playing out cleanly. Very interesting to keep those things in mind. Specialty is different than diversified, which is different than plastics. Again, that's what we're looking for here. Getting our language correct. What are these groups and how do they trade? The PEG ratio, of course, this is the key to the future. Again, you can see the paper groups coming up nicely here, and you can see over here the chemical groups are now starting to rally in the post-opening area. So again, that's probably consumer related, and you like to see these things. So once again, it turns out really consumption is holding up the parts of the basic materials companies that are related to it, less so for the other groups, particularly gold and silver. That's a story we're learning here. All right, price to sales. Of course, I'm going to finish up here, like I said. These are the relative ratios. So let's get through this. Again, specialty chemicals, diversified chemicals, plastics. Very different stories based on their business models. Paper trending upward, again, strong sign for the consumer. And over here, mining non-ferrous doing better relatively than gold and silver now in this post-opening period. Over here, you see iron mining actually being the stronger suit versus steel producers and specialty steel makers. But the specialty steel makers and the steel producers are trending upward. They have the better trend. They don't have the better look. So again, you got to kind of like steel and you got to kind of like paper. And over here, you've kind of take a look into the specialty chemical players. That's it for me, guys. I hope you enjoyed this. And if you want to get these slides, 866-794-6065 is our phone number. Our email is strategycall@zackspro.com. You can find us on LinkedIn at Zacks Professional Services, on Twitter at ZA Tools, and on the web at www.zackspro.com. Once again, the phone number 866-794-6065, and our email, strategycall@zackspro.com. You can get the slides from us. You call us or email us. That's really a benefit for you. That's why we do these things. The slides, there's so much detail that we can give to you. That's what information provides. Better stories, better investment, and that's what we did today.